Hi! Welcome back to Marina Teaches for another CAPE Entrepreneurship tutorial. We will be exploring everything that you need to know about venture valuation. Don't forget to like and share the video and to subscribe to my channel. Let's get started. A business valuation provides the business owner with knowledge, like facts and figures regarding the performance of the business and information about the market, its competition, assets, and income values. For potential buyers, it provides a thorough and objective review, investigation, and analysis of 5 critical areas of the business to determine its worth or value. These 5 critical areas include the motivation. In other words, why does the owner want to sell the business? Secondly, asset valuation, or the physical condition of the business. Third, the market potential. Fourth, the legal issues. And fifthly, the financial soundness of the business. A profitable business will be worth more than an unprofitable one. Venture valuation should take place at least once a year, and not only when the owner is considering selling. An annual valuation also helps the owners to track growth and performance. Now let's talk about the importance of valuing your venture. Firstly, venture valuation is important when you are considering whether to buy or sell a venture. It helps the company to understand its resale value and to accept only offers that reflect its worth. This is also true when considering mergers with or an acquisition of another company. For example, in 2012, Facebook acquired Instagram for $1 billion, although it was worth only $100 million. Valuing the venture also helps to determine tax obligations in the event of a sale. Secondly, valuing a venture gives better knowledge of a company's assets. This is particularly useful for insurance purposes. Also, this helps the business owners to assess the financial health of the company and to determine how much to reinvest if needed. Venture valuation also tracks the increases and decreases in value over time, and it allows business owners to make better decisions. Thirdly, venture valuation is important when raising growth capital, especially through an IPO or an ESOP. An IPO, also known as Initial Public Offering, takes place when a company evolves from the private ownership of its shares to a company whose shares can be traded on the stock exchange. For example, Facebook shares went public for the first time on May 18, 2012. That was their initial public offering. On the other hand, an employee stock option program or employee share ownership plan is an internal incentive arrangement where companies allow employees to buy a share of their company's stock or shares at a set price, thereby allowing them a stake in ownership. For example, Public Supermarket is the largest. Also, valuing the business is important when crafting a harvesting strategy. Inevitably, an entrepreneur will need to make decisions about the business's future, which would enable succession planning, especially in the event of death, retirement, or divorce. Now, let's go through some popular. Firstly, let's look at the book value or balance sheet value approach. As we know, the balance sheet is a financial statement which shows the financial position or net worth of a business. It is based on the accounting equation assets minus liabilities is equal to capital, which is also known as the owner's equity. The owner's equity is the net worth of the business. Some advantages of using this approach is that it is relatively simple to understand. It is straightforward, especially since most assets are recorded at their historical cost. So, that means the cost of the assets can be verified by source documents. Some disadvantages of using this approach include costly asset appraisal. Valuing intangible assets such as goodwill might be difficult, and of course, human data entry errors during the data. Now, let's determine the net worth of a venture enterprises using the balance sheet approach or the book value approach. Remember that the net worth is equal to the owner's equity. This is determined by the accounting equation, assets minus liabilities. In this example, the total net assets is equal to $338,450. We need to minus our liabilities of $175,000 to give us the owner's equity of $163,450. Another valuation method is the earnings per share or the price-earning ratio. This determines the relationship between the company's stock and its earnings. It is calculated using the formula share price divided by the earnings per share. Equity is calculated by multiplying the annual net income by price-earnings ratio. Some advantages of using the price-earnings ratio include it's widely used, it's quite popular, it's easy to calculate and can be used to make quick decisions. It can be used for future forecasts as it determines what is generated for shareholders, and can be used to analyze past and present data to make informed decisions for the future, which can help determine potential growth as well. It can also be used as a benchmarking tool to measure the performance of the company, to compare and contrast with other competitors in the market, and also to determine whether the stock is undervalued or overvalued. This helps to manage the expectations of a venture. Some disadvantages of the price-earnings ratio include it does not consider the debt or the financial structure of the firm. It's not applicable to all businesses like sole traders and partnerships who do not issue share capital. And thirdly, stocks traded on the stock market can be volatile and subjected to change without notice. Okay, let's look at a quick example using the price-equity ratio. Suppose a company has a share price of $75 and its earnings per share is equal to $5, then the price-earnings ratio or the earnings per share ratio is equal to $75 divided by 5, which is equal to 15. A third method of venture valuation that we will discuss is the discounted cash flow or discounted future earnings method. This method of valuing a business forecasts a company's earnings several years and then discounted it back to the present value using the weighted average cost of capital. It attempts to establish the future earning power of a business in current dollars. Why, you might ask? Because the value of a dollar today will be worth more than the value of a dollar years from now. In other words, you can probably get more for $1 today than you would be able to buy 5 years from now due to the loss of purchasing power of money. And just in case you were wondering, the formula to calculate the discounted cash flows is 1 over 1 plus k to the power of t, where k is the rate of return and t will be the number of years. Now, let's go through a quick example so you can get some practice with this formula. Now let's say that a business projects its net cash flows to be $50,000 at the end of year 1. When we use the formula, we will divide the 50,000 by 1.2 to the power of 1. This will give us a net present value of $41,667. We can follow the same process for the subsequent years as shown on the table. We can also add up all of the total net present values of our cash flows at the bottom. Take a few minutes now and try to calculate the net present values for each year by yourself. Tutorial on Business Venture Valuation. Thanks for watching. I hope that you understand this concept a lot better now. Don't forget to like, to subscribe, and to share this video. And also comment down below which method you think is best for valuing ventures. Bye for now. See you then.